Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Tuesday, March 29th, 2022, and I'm pre-recording this Trading Places Live for just a little bit later this morning. Currently, we got futures up again. Futures have been on a roll. Well, the market overall has been on a roll now for about the last 2 weeks. And it looks like we're going to continue that at the open today. We've got Dow futures up 128 points, S&P 500 futures up 17.5, NASDAQ futures up 54.5. So really good action across the board, a little bit more than 1/3 of 1% across each of those major indices. Crude oil prices up a little bit this morning, up about 1.5%, back to 107.50 per barrel. The 10-year Treasury yield continues its trek higher, up nearly 3 basis points this morning to about 2.5%. So where do the bulls go from here? Well, we're going to talk about some of that, some of the things maybe to look for. Let me go ahead and go through your agenda with you. First, we'll take a look at the daily market recap, as we always do. Take a look at Monday's action. Then we'll get into talking technically. That's where I want to pull up some of these prior bear markets, just to cyclical bear markets anyway, just to show you kind of the rebounds that we've come to expect in some of the others and where this one stands. Then I want to talk a little bit about leveraged ETFs. I wrote about this from the very beginning when the leveraged ETF first came out, about the fact that you can lose value. These leveraged ETFs erode over time, and I'll show you a little bit about what I mean by that during the leveraged ETF section. Then we'll get into earnings spotlight. Not a whole lot going on, a couple of companies there, and then the three you must see, 3 companies that really are starting to show some strength. These were old leaders, and they're beginning to show strength again. Definitely worth at least monitoring, keeping an eye on. Before we get into any of that, let me take you over to earningsbeats.com. For those of you who are new to Earnings Beats, if you go over to earningsbeats.com and you scroll down, you will see we have a free newsletter. No credit card required. You can unsubscribe at any time. All we need is your name and email address, and we'll get that out to you 3 times a week, Mondays, Wednesdays, Fridays. Very simple read, normally just 2 paragraphs and a chart, maybe 5 minutes tops, and you'll be through it. And normally it's out around 8:30 in the morning Eastern. So we try to get it out about an hour before the market opens, give you plenty of time to take a look at it. For some, it might be actionable trading ideas. That's completely up to you. We use it as an educational tool, just simply to provide our community with an interesting stock and how we look at things at in the market. So it could be focusing on relative strength. It could just be a chart on the overall market itself. Could be looking at sentiment. But we do look a lot at relative strength, earnings, gaps, candlesticks, that sort of thing. But we like to give back to our community. And also we do free events from time to time, and we always reach out to our Earnings Beats Digest community for those. Speaking of free events, we do have one this Wednesday. It's free in terms of you need to be a member, but we have a 30-day free trial. So this is a members only event, but you don't have to pay anything. So if you are not a member currently, but you'd like to take a look at what I have to say about the resumption of the secular bull market, you can just click on this link on our homepage, and it'll take you to a page where you can sign up and make sure you reserve your seat there. All right, let's move on and talk a little bit about what happened on Monday. Dow Jones Industrial Average up another 95 points, S&P up 32. Look at that NASDAQ, 185 points. So on a percentage basis, 1.3%, much higher than the 0.7% on the S&P and the less than 0.3% on the Dow. So the NASDAQ, the big winner on a relative basis. Mid caps up just a little bit less than 0.2%. Small caps down actually on Monday, down about 0.4%. Looking at the individual sectors, discretionary led. Discretionary had been beaten up pretty good during the first couple of months of the year. After printing that double bottom, though, in early March, we have rallied back strongly, and now we are going to have a very significant test at 190 on the XLY. And I say significant because, hey, you're in a downtrend as long as you have lower lows and lower highs. And this is the lower low. This is the lower high. And then you come down to the lower lows, this double bottom. And so breaking above 190 would end that trend, number one. Number two, notice where we bottomed back in December. Went all the way down to that 190 level, bounced back up the beginning of the year to 210. And then when we came back down, we could not hold that support level. Broken support becomes resistance. That's TA 101. So you've got this 190 level already showing as key, excuse me, resistance. And I think given the start that we've had to 2022, I think it becomes even more important here. So can the XLY break through 190 on a closing basis? That would be a really good development for the bulls if it were to happen. Real estate also had a strong day, up about 1.25%, breaking above its reaction high back in February, closing at 47.73. Continuing move there would be bullish. Watch that rising 20-day, not just on the real estate group, but really overall. Could say the same thing about the XLY. Any pullbacks, it would be normal to pull back after the 2-week run we've had. The question is, on pullbacks, do we hold the key moving averages? So I think we're starting to tighten our ranges. As you can see, the resistance overhead, and then to the downside, you've got these moving averages. Technology also a strong day on Monday, up more than 1%, close to 1.2%. It too has moved above its moving averages, still got some work to do to get back up to the February high. Energy, not so good, down 2.5%. It seems like energy, technology, and discretionary all just kind of flip-flop back and forth between leadership and being laggards. Energy being the laggard this time, technology and discretionary among the leaders. Materials also weakened yesterday, down nearly 0.5% after a really stellar move to the upside. The dollar's been strong. The dollar tried to break out on Monday. It's a little unusual to see materials rising with the dollar, but that's what we've been seeing of late. If the dollar makes the breakout, it's hard for me to see materials also making this breakout. 10-year Treasury yield. This is as of the close yesterday, 2.47. And as I look at this morning, and we still have a couple hours before the market opens, 10-year Treasury right now is at 2.51%. So it's up a little more than 3 basis points. So we're looking at yet another high on the 10-year Treasury yield. You know, and I think I mentioned this in Trading Places Live yesterday over at Earnings Beats. But isn't it funny how when the yield was going up back earlier in the year, remember when the yield was jumping in early part of 2022, we went over 1.75%, broke out to like a 52-week high, and all the media was talking about how growth stocks can't withstand, you know, the stock market can't stand these higher interest rates, blah, blah, blah. And the rates kept going up and the market kept going down. That's all you saw in the media, inflation, interest rates, blah, 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 right? Look at what's happened here over the last 3 weeks. We have seen the biggest move in interest rates to the upside. We've got continuing high inflation. And where's the media? Why is the stock market rallying back 10 straight days? Wait a minute, interest rates are going up. We still got inflation. Do you understand that the media, all they care about is their hype, their headlines, and driving clicks? Now, all of a sudden, higher interest rates aren't a problem for the stock market. So what are we going to focus on? Well, we're not going to focus on that because it doesn't make any sense. Interest rates, the key takeaway here is interest rates remain historically low, which means there are very few alternative investments. That's why the secular bull market's going to continue. That's why back in the early 1960s, when we were looking at almost this exact same scenario, we had interest rates starting to rise. We had a little bit of inflation kicking in, blah, blah, blah. Market continued moving higher throughout the 1960s. The secular bull market went on for another decade. While we had, I can't remember exactly how many, but I want to say 3 recessions in the 1960s. All of that occurred with the stock market continuing to rise and interest rates going up. Interest rates are still very low. I wouldn't worry about interest rates being the culprit of a significant decline until we start to talk at least 4.5% to 5% minimum. We get up there, then I think we can start having conversations about what that might mean, because then all of a sudden, Treasury yields, if they're up at 4.5%, 5%, that is risk-free money, risk-free investment, giving you 4.5% to 5%. Now you got something to think about. When the stock market historically only gives you 8 or 9%, but you've got risk-free, you don't have to worry about it at 4.5 to 5%. Right now, 2.5%, it's not enough. It's not enough to drive the money out of the stock market. And that's why I keep talking about the secular bull market. Everyone wants to focus on the news and the headlines and the inflation and the war. And hey, all these things are bad. COVID. I mean, all these things are bad. Don't get me wrong. They're bad, but they're not going to change the overall direction of the stock market, the long-term direction, just all in my opinion. Anyhow, 10-year treasury yield continuing to rise. That will impact, I think, the relationship between growth and value, because as interest rates rise, there's no doubt that does impact growth stocks more than value. But it's not enough to derail the entire market and send us into a secular bear market. I don't see that at all. Haven't seen it. Talked about weakness this year, but I've said we'd come right back up to new highs. Did I think it would be this quickly? No. I mean, I talked about maybe, but I would have thought maybe, 6 months, not 3. That we would be all the way back up or getting closer and closer to all-time highs. But we still have some work to do, and I'm going to talk about that some more in just a minute. All right. Actually, let's just go ahead and talk about it now. So the S&P 500, let me show you. This is the secular bull market. So for talking technically, what I thought I would do is show you the long term. I do this all the time. Anyone who's a Earnings Beats member, and many of you who follow my work, even if you're not Earnings Beats members, are aware of this chart. It just gives you the long-term perspective of the stock market. You go through periods where the stock market really struggles for many, many years. This is a 20-year secular bear market. Here's a 20-year secular bull market. Then we've got a 12-year secular bear market where we basically go nowhere. Then we got another 20-year secular bull market. Then we go through another 12, 13-year secular bear market. And then we start, and we've been in this secular bull market, which I think is going to go on for 20 years, just like the last couple. We still have very, very low rates historically. I think the groundwork still laid for the market to continue moving higher. Unemployment remains very, very low. You get caught up in the day-to-day stories and the debt and this and that. But as long as the economy is growing and the environment is conducive to more growth, we're not going to run into problems with the debt. We're not going to run into problems with 2.5% interest rates. It's just not going to happen. Will we have blips along the way? Sure. We had the trade war. We had the pandemic. Call this one what you want. The inflation surge. Maybe it's the Russian-Ukrainian conflict. Maybe it's a combination. Maybe it's the Fed, putting the brakes on, starting to raise rates, putting the brakes on the economy potentially. But all this is going to pass, and the market, I think, goes to new highs. That's the way that's my big picture view. Now, beginning of the year, I talked about sentiment needed to reset, and I thought we were going to have a cyclical bear market, which is a short-term bear market. These are not uncommon. We had cyclical bear markets back in the early 80s. We had 1987 crash. We had the 1990-91 recession, the Persian Gulf War at that same time. 1998, after all this buying, we had a 20% cyclical bear market, very quick 3-month correction. Go back to the 1950s and 1960s. We were in secular bull markets, but we had periods, 1957, 1960, 61. We had 1962, 67 or 66. These were all cyclical bear markets within secular bull markets. So we could be in another one of those right now. I believe we are in one. Technically, the S&P never lost 20%. So there will be many folks that will argue with me. But I think potentially we're still in what I think could be a cyclical bear market. Many areas of the market are already cyclical bear market in nature. They were down more than 20%. NASDAQ was down 20%. So small caps, mid caps down more than 20%. So the fact that the S&P was down, 14%, 15%? Again, if you want to, stick to your guns and say, hey, the S&P didn't lose 20%, so therefore it's not a bear market, go, feel free. That's open for debate as far as I'm concerned. Anyway, the S&P 500's got some work to do, and I'll show you that in just a minute. But, we topped beginning of the year. We're kind of moving back, and it's okay. It's all right to have a period of selling. You don't go straight. Look at these prior secular bull markets. We had periods of a year or more. Here from 56 to 58, we struggled. That's a little unusual, but it happens. We had 2015, probably the end of, or maybe beginning of 2015 to early 2016, where we went sideways for a while. Looked like we were breaking down, and the market took back off again. Every time you think the market can't go higher in a secular bull market, that's about the time it's going to go higher. All right, so let's take a look at the S&P 500 right now. I mean, this rally that we're seeing, it's been a really good rally. I mean, we're talking just off the lows from 2 weeks ago, it's up 10%. 10% in 2 weeks. 10% is a good year. Normally on the S&P 500, I mean, it's better than the average year since 1950. We average about 9%. So 10% 2-week rally is pretty unbelievable. But we keep it all in perspective. It comes on the heels of a lot of selling. We still got work to do. We still got another 230 points to get back up over 4,800. So that's still, another 5% from here. We still need another 5% to get back to the all-time high. Will we do it now? Will we do it later? I think that's open for argument. I believe we're going to do it. I think it's a matter of whether it's now or whether it's later. And when I'm talking later, I'm not talking 10 years. I'm talking later as in later this year or possibly into next year. And that's only if we turn back down again. I think if we go back through 4,600, we're going to be in a period of consolidation. I still don't think we go right back to new all-time highs, although I could be wrong. It wouldn't surprise me. Again, we're in a secular bull market, so I believe we're going up there eventually. It's just whether or not we do it now or whether we do it later. So right now I'd be watching this double top, because here was your big move down to establish that first low. Here was a massive reaction high back to the upside. And if I annotate this and just kind of draw this line from here to here, I mean, you can see we went up about 9% there. It's up about 10% here. We haven't broken out yet. And as you look at the S&P, I mean, I'm looking at the volume dwindling back down to about 2 billion shares a day, which is pretty light for what we've seen this year as far as selling to the downside. Now, a lot of people look at that and say, well, that's really bearish. I don't look at it that way, because there's no reason to panic buy. The market doesn't panic buy. It panic sells, but it doesn't panic buy. So the only big day of really big volume was option expiration day. Go figure. Now there might be a little panicking going on, but it's probably the market makers trying to drive prices higher to squeeze everybody out of their put premium, which I talked about at the beginning of that week. But most of this move to the upside was made during option expiration week. But we have continued another 100 points. I mean, we've tacked on another 2 to 3% since then. But can we get through 4,600? I think that's going to be the key level for us. All right, so let me get out of this and let's take a quick look at a few secular. All right, so let me just walk you through by decade some of these, bear markets, these cyclical bear markets. Now here, what you can see back in 1953 only went down 15 or 16%, and we snapped right back out of it. Looks a little bit like what we're looking at right now, doesn't it? Pretty much just straight up. Probably was pretty scary back then. Here's 1957, down 21% from top to bottom in 3 months. After a little bit of consolidation, right back up again. In the 1960s, here were three different instances of cyclical bear markets. Although you might argue that the end of 68 began the secular bear market. Early 70s, we did break out above this high one more time. So that's kind of up for debate, but these two were both cyclical bear markets. 1962, you can see the 6-month decline here of 29%, came back down, went in, put a double bottom. And does this look familiar? After putting in a double bottom, that's kind of what we're doing right now, right back up. Now, we didn't go down 29%, but these candles look very similar, don't they? I mean, almost every day up. One down day, and then almost every day up again. Then finally a 20-day test, and then back up, 20-day test, and then breakout. Here, a couple of legs lower, but when we finally started getting back up above the 20 and especially the 50, it was over. The selling was over. Here we went down, got the double bottom, and then back up. 1970s, there was the ultimate high. That was the 1973 high. And that really is when things began to turn south in a hurry with the oil embargo and everything going on back then. But 73, 74 rough years. But this is a secular bear market. I'm not looking at what we're into right now as a secular bear market. So I'm going to skip the 70s. Let's go into the 80s. This, again, was this the very tail end of a secular bear market? Was it the start of a bull market? Really depends on how you want to define it. But it was very lengthy bear market, 28.8%, and it was almost 2 years long. But look what happened when we came out of it. We were back at the high in 2 or 3 months. 1987, big move down. Once we started getting back up above these moving averages, it was all over. 1990s, here's the Persian Gulf War. Moved down, bounced, didn't quite get back to a new low, and then right back to new highs. Never saw that low again. 1998, move up, move back down right here, and then look how quickly right back to the upside we go. 2000s, now we're talking secular bear market. Much longer, much more drawn out, 50%. Much longer, much more drawn out, 57%. These were much more, these were different. You know, we didn't see an all-time high throughout this entire period. This might have eclipsed the high from earlier. I don't know if that took out the 2000 high or not, but if it did, it was maybe by a couple points and then right back down. Certainly not what I would consider a meaningful breakout. 2010s, we could talk about some of these moves back here, but this was not at all-time highs. I like to deal with pullbacks from all-time highs. So in 2015, 2016, there was another 15%er. And this one, I'm wondering if we're going to see something similar to this. The pullback, the move back up, didn't get a breakout, and then back down again, kind of equal lows, and then we go. So are we going to consolidate like we did in 15 and 16? That's a possibility. 2018, the trade war came down. Look at us. We were right back up 3 months later, new highs. And then the current environment there was the pandemic. And again, right back up. And now here we get this pullback. 20% would take us down to about under 3,900. We didn't make it. Right now, I think we went down to about 14%, something like that. And we've now rallied back off of the low back in February. We've rallied back about 11.5%, 10% from the recent low 2 weeks ago. Anyway, can we get through 4,600? That's the question. Next, I want to talk about leveraged ETFs. And this is something I think that's really, really important. I just want to point out a couple of dates to you. 10 days ago, the NDX was sitting, this is the NASDAQ 100, was sitting down close to 13,000, and it rallied back to almost 15,000 now, very close to these highs over here. With this rally, you can see that the rate of change was 14.88%, 10-day rate of change. That's going back to the close on the 14th, 10 trading days. So it went up 14.88%. Over the last 32 days, which is this high right here, you can see the index is almost back to where it was, not quite. So it's down 0.46%. Now, I want you to remember these numbers. First number here, the rate of change, 14.88%. I'm going to pull up the QLD, which is a leveraged ETF that tracks the NASDAQ 100 2-to-1. So over the last 10 days, the NASDAQ 100 up 14.88. That means the QLD should be up 29.76. When we update this, it's up 31.25%. It's actually up 2 percentage points more than what I would have thought. The reason is compounding. These leveraged ETFs are awesome when you catch the trend, but you've got to have a relentless trend to the upside. It's the back and forth action that really crushes the these leveraged ETFs. So that was the move on the QLD versus that February high that I talked about. Remember, the NDX lost 0.32 or 0.46%. So that means QLD should have lost 0.92%, right? Because it's twice Well, look what it lost. It lost 2.38%. It lost more than it was expected. And what becomes even more crazy is, let's say you wanted the TQQQ, which is the triple QQQ. Let's pull that up. So over the last 10 days, remember, it's under 15%, 14, I forget what it was, 1492 or 1488. I think it was 1488. Well, 3 times that would be somewhere around 4460 something. It's 4932. So during the uptrend, it more than tripled. Well, what did it do during the period from this February high? Remember, what was it? 0.46 loss. 3 times that would be 1.38% loss. We lost 552. It's the way these leveraged ETFs are priced. They're priced using derivatives, and the ups and the downs over time, you will see erosion. And another way to look at this, let me pull this up. I'll give you one more chart here. The way to track the QID, or the way to track the NASDAQ 100 if you wanted to short it, is with the QID. So let's go down here and just put in price. QID. Just do a solid line and do a height. I want to show you something really interesting here. Now, we have not gotten up to this high. So let's say that right here on this peak, you were brilliant. You said, I'm going to short the market. I'm going to short the NASDAQ 100, and I'm going to do it with leverage. I'm going to buy the QID. Well, from there, early February to here, we're still down on the NASDAQ 100. So that means we should be higher on the QID, right? The QID has broken down beneath both of these prior lows, which coincide with these highs. Do you see what's happening here? The erosion of the ups and the downs. When you get back to that prior high, if we go up to this high, the QID goes even lower. It's probably going to be down, I don't know, 6-7%, even though the market's gone nowhere. That's the danger of these leveraged ETFs. Not a whole lot with earnings. Just want to mention Jefferies reported stock was up a little bit pre-market. On a relative basis, though, this is a stock that hasn't really been doing great. So I'm not sure it sticks, but at least looks like it's going to go higher. All right, the 3 you must see. We'll go through these pretty quickly as well. I just wanted to point out these are 3 stocks that did really well in the past, but had been really struggling since the market topped back at the end of 2021. Cloudflare, big move down. Look at these reaction highs all coming in around 120. Well, we've broken out above that, but we are right now challenging this breakdown level around 127, 128. If we get through 130, this is a stock that I think should be considered in an uptrend. Maybe even now it should be considered an uptrend, but I would still wait and see if I can get a 20-day test on Netflare. The next one I had for you was Sonos. This was a stock that did really well about a year and a half ago. Been in this downtrend. You can kind of connect all these highs with a trend line. Look at the volume coming in and the stock breaking out. I think this is a change in character for the chart. So this is one that I'd be very interested in going forward. And then the last one is Trade Desk, TTD. This is one that's in a bull flag. Nice move up, sideways consolidation, a break above the 50-day. This would measure up to probably about 90, or at least up close to this prior high. So maybe watch for that breakout if we get it. All right, that's it for me. Appreciate everybody tuning in. Hope you have a great day. I'll be back tomorrow over at Trading Places Live, or over at Earnings Beats for your next Trading Places Live. Have a great day, everybody. Happy trading.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.